Hello, I'm Sarah Allen and welcome to the listed series for 2024. There are now more than 370 exchange-traded products on the ASX. So where does an investor begin to start to sift to choose which ones are right for them? To help us answer that question, today I'm joined by Adam DeSanctis from Vanguard and Chris Brycki from Stockspot. Gentlemen, welcome.
Thank you. Thanks, Sarah.
So to begin with, what are some practical steps investors could take to start to sift down the universe? Adam, I'll start with you.
Before narrowing down the ETF universe, an investor should ask themselves two important questions. What are my financial goals? Are you saving for a long-term strategy such as retirement, or perhaps something a bit shorter term, such as a holiday, or perhaps a child's education? Once you have clarity around your financial goals, then you can create an asset allocation that will allow you to take a proper amount of risk and give you the proper time horizon to give you the best chance to meet those goals. And the ETF is really just a vehicle for helping you to achieve that asset allocation. So I think framing the question in a more holistic way can help investors to narrow down the universe. Now, when it actually comes to selecting ETFs, there's really two ways to do it. You can start with more of a building block approach where you go out and find broad-based ETFs that will get you exposure to each of the desired asset classes. There are also ETFs commonly referred to as diversified funds that might allow you to actually get broad-based exposure with just one click of the button.
And Chris, does this match with how you start to sift down the universe for your clients?
So our approach is very similar to what Adam's just described, and actually our approach hasn't changed from 10 years ago when we started analysing ETFs and there was only about 50 listed on the ASX. Now there's hundreds and hundreds available. First you really need to sit down with your client, or as it happens with us, go online and meet your client. Work out what their goals are. Are they investing for the long term, medium term, short term? What are they trying to achieve? Is it cash flows? Is it lots of dividends? What are they actually trying to get out of their investments? Then you've got to create the asset allocation that's going to be most effective to help them reach those goals. And similar to what Adam described, risk is the most important factor to consider. What's the right amount of risk for that person to take? Because ultimately that's one of the few things you actually can control when you're investing. And then finally, it's working out the actual instruments or securities you're going to use to embody that asset allocation. And for us at Stockspot, we exclusively use ETFs because we think they're such a fantastic vehicle. But actually the ETFs we recommend today are no different to the ones we were recommending 10 years ago. So having a lot more products to choose from doesn't necessarily mean that investors should be choosing different products.
Okay, so on the note of different products, ETFs are far from the simple index trackers that we think they are. How do investors think about the different types of ETFs there are? How do they know if they're suitable? Chris, I'll start with you.
Sure. So as you mentioned, regionally ETFs came about because they're a great way to track an index. And there was a lot of evidence that was coming out in the 1970s showing that really tracking indices was a really effective way of growing your wealth and avoiding a lot of the risks and pitfalls of investing in other ways. Probably a lot of investors that have heard of ETFs in Australia would imagine these types of index tracking ETFs. And certainly when there was only 50 or so listed 10 years ago, most of them fit into this category. Now that there's a much bigger array of ETFs, they fit into a few other categories. The first one that really started to come about after these index tracking ETFs was more niche ETFs tracking very, smaller sectors of the market. So it might be just tracking resource shares, or it might just now be AI related shares. So these ones I would call sector or thematic type ETFs that give you a more granular exposure to a part of the market. These ones, we would suggest only using as a small part of your portfolio because they tend to come with more risk. And we tend to find that investors make poor decisions because they usually jump into these ones after they've performed well in the past. And usually there's a mean reversion aspect in markets where they tend to perform badly after that. So they're more thematic or sector-based ETFs. And the other group that's becoming more popular, certainly from a listing perspective, is active ETFs. Or active managed products. These are historically products that weren't in an ETF or a listed format. Often in Australia they were unlisted managed funds, or they were in a listed format via listed investment companies. But a lot of these product manufacturers have realised that this ETF type format is a lot more investor friendly because this trades closer to its net tangible assets, and it's also very easy to get it in and out at fair value. And so they're probably the three big groups that are now listed. And certainly over the last 5 or so years, we've seen a lot more in the thematic and the active space list. Although still, based on our research at Stockspot, most of the money is going into the broad-based ETFs. So about 90% of the flows are still going into those traditional index ETFs.
Okay, and the broad-based indices would be generally suitable for most investors compared to an active ETF might be only suitable for some. Is that correct?
I mean, based on the evidence of, what's the most, lowest risk way to grow your wealth over the long run, our view would be yes. And, there's not a lot of evidence out there that shows that many people are successfully able to implement more thematic ETFs or active ETFs in their portfolio and actually achieve market-beating returns. And the evidence, you see in the Spiva report every year that only 10 to 20% of active funds actually beat the market over the long run. When we do our research into the ETF world, it looks about the same over 5 or 10-year periods. It's very hard for these active ETFs to beat the market. The thematic ETFs, there are some that always beat the market and some that underperform, but what you tend to see is that the flows chase performance. So on a asset-weighted basis, investors tend to do poorly because the money goes into them at the peak of their performance. A great example is Cathie Wood's ETF in the US, which has done brilliantly over the last 10 years, but actually on an asset-weighted basis, people have lost money in it.
Okay, so you just mentioned a US-based ETF. Adam, you've had quite a lot of exposure to the US market, which is substantially broader and more sophisticated than the Australian. What lessons do you think Australian investors can take from the US about using different types of ETFs?
Exchange-traded funds are exchange-traded products, but it's not necessarily the case the other way around. So when we think about traditional ETFs, they tend to hold a diversified set of securities, and usually they're owning these securities directly, tracking an index or another asset class. There are other exchange-traded products that are not as straightforward to understand. In the US, we've seen in particular products that may use derivatives or other investment strategies to alter the returns of a product. So maybe they're trying to magnify the returns, or maybe they're trying to track the inverse of a benchmark. And one of the lessons for investors to keep in mind is to make sure that you understand the risk and what is actually in the product. For example, when looking at a long-term investor, some products might have actually recommended holding periods that are different, perhaps 1 day or shorter than the long-term investor. So do your homework and understand the risk before investing.
To add to Adam's point, I would say those leveraged ETFs in Australia, they've existed for a while as well, and it's an area we've studied quite closely. They tend to be very popular with investors because they do magnify those returns, and it's very exciting when the ASX goes up 1% to think that you can earn 2.5% or 3%, and that sort of magnification is available through listed products now. The problem is that the funding costs to achieve those returns embedded in those ETFs are very high, and so owning those ETFs for any extended period of time is a pretty poor strategy for investors. Actually, interestingly, one of the best, most profitable ETF strategies is actually shorting a leveraged long ETF plus a leveraged short ETF because they cancel out each other out, but the funding costs embedded in them actually make you earn money over time. So it's a sophisticated strategy, but actually shows how poor these products are for investors over the long run.
Okay, so I'm going to turn to the fact that there's a lot of ETFs targeting similar asset classes or even the same types of benchmarks. Adam, how do you go about comparing these ETFs?
Yeah, absolutely. So there are a few things that come to mind. The first is cost. So especially when comparing ETFs that offer similar mandates, if the management expense ratios, the common way to measure cost for these products, is drastically different, that's likely going to lead to a very different investment outcome for investors. So cost is the first one. Second is past performance. So when you fast forward to the current environment that we are in, and in some parts of the market, ETFs are only differing by single-digit basis points. So it's really important to look at past performance and to ensure that the ETF is actually performing well versus the index. Indexing seems straightforward, but when you actually look at the complexity and the expertise that is involved from the investment management teams, it's very important to check that. And then lastly, on the note of cost is ETF bid-ask spreads. So the MER is a very popular quoted cost, But because the ETFs are exchange listed, there are trading costs associated with ETFs, and investors want to make sure that they're not choosing the lower MER only to pay more on the trading cost side.
Okay, and there's a lot of ETFs being listed almost on what feels like a daily basis in Australia. What do you do if it doesn't have a long performance history? What should you watch for instead to compare it?
Yeah, I think it's still a lot of the same things. So start with cost, start with some of the trading things, and you can also look at the index as well. So the index methodology will be another great place for investors to look to get a good sense for what to expect for the product.
Okay, and what do you look for, Chris? Are there any screens or tools that you recommend investors could use as part of their search?
Well, I think first of all, the two that Adam has mentioned are two of the most important for us as well. So costs, ton of evidence that shows that it's incredibly important over the long run because the compounding impact of cost is a big killer for investors. Then past performance and the track record, what index does it track? How long has it been around? What's its performance like in different economic environments? When there's high inflation, low inflation, good periods of growth, high periods of unemployment, you want to see how it's tracked over those periods. I think the two other factors that we would be encouraging investors to look at, and certainly a part of our analysis, are the relationship between investments within your portfolio. Technically you'd call that the correlations. And why that's important is because in order to achieve great diversification and a smoother path to growing wealth, you actually want assets that do differently in different environments. Because if you have everything that looks the same, you might as well just have one ETF in your portfolio. And so, for instance, this week was even a great example. The Australian share market had its biggest one-day fall in a year. It fell about 1.8%. But on the same day, the gold ETF was up 1.4%. This is a big part of our portfolios because it has a wonderful negative correlation with shares, which helps to smooth your returns over the long run. And the two asset classes that tend to do that in different environments for shares are government bonds and also gold. And so having diversifying assets is important. The other thing I would be looking at if you're an investor analysing ETFs is actually what are the underlying securities within that ETF? Because something we see time and time again with clients is that they come to us thinking that they're well diversified because they have 10 or 20 ETFs. But if you actually look at what's inside those ETFs, it's the exact same stocks. They might own a NASDAQ ETF and then an S&P 500 ETF, but actually there's 70% overlap of similar stocks in the different indices that people have. And so, this is information that's available on the ETF issuers' websites. It's quite easy to access these days. But if you do have several ETFs or you're looking to build a portfolio, make sure they have different underlying securities. Otherwise, it's pointless buying multiple ETFs.
So thematic investments such as AI have become really popular in recent years, and we've seen quite a boom in them hitting the ASX. But they come with a few concerns, such as performance and fees. Adam, what tips do you have for investors considering using these investments, and how could they incorporate them as part of their strategy?
Absolutely. It's understandable why investors would be curious about these types of products. AI and these other themes, they're mega growth themes, and oftentimes they're reshaping the way that we live our everyday lives. So an investor might be thinking to themselves, where could this fit into my portfolio? And there's really three things that I want to highlight relative to the broad-based index funds. The first, which we touched on, is diversification. Investing in a narrow subset of the market could lead to volatility of portfolio returns. The other is an element of market timing. These trends are extremely difficult to predict, and they might not even be long-term investment trends over the long term. So there's definitely an element of market timing that you can try to avoid. And then lastly, it's just cost. Even though broad-based index products, the costs have come down significantly, you can still pay multiples to access these thematic products. So similar topics to what we've talked about, but really just keeping those three things in mind.
Okay, and Chris, I know you don't use them in your portfolios, but if you were ever going to incorporate one, how would you approach adding it onto a strategy? What sort of allocations might you think about?
Well, probably the reason we don't have them in our portfolios is because they're already in the portfolio. So Nvidia, a very popular stock at the moment in the AI space, had wonderful growth over the last few years. It actually makes up about 8.5% of the global index ETF that we invest in. And so the beauty of owning an index ETF is that as industries become bigger and more successful and companies are doing well, you get more of them naturally within your portfolio. And as they don't do well, they shrink within your portfolio. So you're naturally always getting exposure to great sectors if you're investing in the index. The trouble we see is if you specifically pick indices the timing becomes very important, and you may have to withstand very big drawdowns in your portfolio if it's too big a part of your portfolio. And the wonderful example that I love to share with clients is Amazon. Wonderful company, one of the biggest, most successful companies in the world today. But actually, looking back at 2000 and 2001, its share price fell 95% from its high to its low. So if you had too bigger exposure to Amazon in your portfolio, even if you're a visionary and realized what a genius Bezos was going to be over the next 20 years, that would have been a really difficult conversation with your partner to say that you've lost 95% of your family wealth because you bet on this one stock. And that's how I think about all types of thematics is, what is the sort of drawdown you're willing to endure in your portfolio? And that should be driving the asset allocation and the underlying sector and stock exposures within your portfolio. So if you are someone who's ultimately willing to have a 95% drawdown, fantastic. You can go hard on those, those types of investments. For most people investing, they don't have that capacity, and that's why we're really focused on risk when it comes to building your portfolios, and that would really determine the right amount in any particular thematic. But also drives why we really like to focus on whatever the index exposure is in that thematic. But going back to your original question, in terms of the perfect portfolio, it really comes down to, as Adam said, what is the portfolio that an individual is going to be able to happily hold on to when tough market events happen. And if that is a portfolio with 100% NVIDIA and you're happy to withstand a big drawdown one day, fantastic. You can just have one stock. You don't even need an ETF. Or if you just want one AI ETF, it's possible that that's appropriate. But from what we see with most clients and seeing the behavioral psychology of most people, once you endure a 30 or 40 or 50% drawdown in your portfolio, it is extremely hard to hold on to that portfolio, which is why we really try and minimize, individual stock risk within a portfolio.
If I could just add one more point. At Vanguard, we think about this idea of core satellite. So for those investors who are really passionate about including a thematic ETF into the portfolio, one of the approaches that you can take is to make sure that the majority of your portfolio is invested in core, low-cost index funds, and then you can use the satellite portion of the portfolio to gain exposure, and in totality, you still maintain that discipline to make sure the investor is reaching their financial goals.
Okay, excellent. Well, we're going to go to the final question of the day, and that's, what are 3 characteristics investors should consider a hard and fast rule when selecting ETFs, and what might be one red flag to steer away? Adam, do you want to start?
Yeah, so I'm going to focus in on the red flags, as I think we've touched on a lot of the other components. There's 2 things that come to mind for me. One is around home bias. So Australians love to travel. They're not as ambitious when it comes to their investments. And it's not something that's unique to Australia. All around the world, it is common for investors to favor the companies that they're very familiar with and to not invest in as much the companies abroad. So that's one thing that I'll call out as a bit of a red flag. And it's really important for portfolio diversification to make sure that you're going as broad and as far as you can.
And Chris?
I mean, one I always, really encourage our clients to be wary of is very selective advertising and backtesting with issuers. So, if you look over the long run, the evidence is very clear about what's going to give people the best chance of success investing. But if you actually look at a lot of the ETF issuers' websites, I've never really seen a website that says that they've had bad performance. They've always had wonderful performance over the period that they've selected. And so investors have to be a little bit cautious about the advertising of any investment product. Certainly doesn't just apply to ETFs, managed funds, listed investment companies, and really be very critical about what time period is that over, but also does it also include all of the other costs I would have had to incur to actually own that asset or achieve that return? Because what we see is that there's a huge variance in advertising between different financial products, not just ETFs, but other managed products, some that still don't even include fees over the long run, and that could have an enormous impact on your actual result because there's actually no way of accessing without fees. So be very careful about advertising because you'll never see an investment product that advertises a bad track record. But what we know is that 90% of products underperform very simple index funds over the long run.
Okay, good tips. Thank you both very much for sharing your insights with us today. If you've enjoyed this interview, please subscribe to Livewire Markets and Market Index for more from the listed series. Thank you for watching.